If you want to learn how to analyze a balance sheet like Warren Buffett, then you've come to the right place. While Warren Buffett is known as one of the greatest investors of all time, you may be surprised to learn that he only employs a few very simple ratios and eyeball tactics to determine whether a company is a good, solid, and value-driven investment for him that is going to produce him consistent returns over the long run. Now, the first and most important thing Warren does when analyzing any company's balance sheet is to look at the trend line of cash and debt over at least a period of 7 to 10 years. Now, why does he first compare the cash and debt line over that long of a period? He is looking right away to see if there's a steady increase in cash with a corresponding decrease in debt. Increasing cash and decreasing debt immediately indicates a company that is self-financing, meaning that it's generating enough cash on its own from its own product or service sales that allow it to be less reliant on borrowing money from the bank in order to run its business. You need to understand the goal of any company is to become a cash-generating machine that can be its own bank. And that's whether management knows it or not, okay? It's super important that a company have the ability to self-finance. This is the first thing that Warren looks for when evaluating a balance sheet of any company. Can the company self-finance, or is it reliant on bank debt? Let's cover a few more things, but first, my name is Nelson Alvarez. I'm a CPA and executive management consultant. Here in the C-Suite, my mission is simple: to put you in the C-Suite. And I do that by providing you real-world actionable insights that will excel you to the corporate level, okay? Now, time is money, so let's keep moving. Now, what Warren does not like to see on a balance sheet is increasing cash and a corresponding increase in debt, because that means the increase in cash is not coming from the sale of products, but rather from the raising of debt, okay? So make sure you look at those two in tandem. You don't want to be fooled. And again, seeing that type of trend indicates the company cannot self-finance. Think of it like a person on a life support machine, basically, okay? The company is completely reliant on bank debt in order to operate, okay? It's on life support. That's not a good sign long-term, all right? The best and safest companies to invest in have lots of cash and very little debt. They don't need a bank. They can survive just fine on their own because they can self-finance. Now, those are Warren's favorite companies, okay? No special analysis needed there. You can take a look in about 30 seconds to figure it out on your own. Now, on screen, I have 6 years worth of balance sheet data for the company Apple. I know I said 7 to 10, but you get the idea. Now, we're gonna walk through it step by step, and you're going to employ the same formulas and tactics for no matter what company you're analyzing to whether invest in, or if you're a manager just trying to better understand your company. If you remember, the first thing I said that Warren Buffett does when analyzing a balance sheet is compare cash to debt. So let's take a look at Apple's cash balance. In a period of just 6 years, Apple has essentially doubled its cash balance from $20 billion to $40 billion. That is incredibly impressive. However, before we give it a massive applause, we have to be careful, okay? Because that doubling of the cash balance could be the result of it taking on extra loans to bolster its cash position to really fuel its operations, okay? So we're gonna hold for 1 second before we give it a seal of approval and just check on that debt balance. Let's focus first on the short-term debt of Apple. How can we figure that out? Where is that on the balance sheet? Well, it's actually the commercial paper line in the current liabilities section. This is basically where the operational business debt of the business is held and would help it essentially get through the day-to-day of paying bills. Nearly all companies have some type of short-term debt, okay? What we have to do is compare that to the ratio of cash, okay? And see, is that ratio climbing, dropping, or stagnant? Again, comparing cash to short-term debt to see if the company is reliant on the bank to fund its day-to-day operations. A quick eyeball of the short-term debt of Apple shows that on average, over 6 years, it's only about $8 billion, plus or minus 3 here or there for taking out and paying back that loan. So that basically tells us that the increase in Apple's cash from $20 billion to $40 billion is not the result of the company taking out short-term loans to fund its operations. This is preliminarily good news, okay? It indicates a company that is not reliant on the bank to fund its short-term day-to-day operations. Again, every company has some type of short-term debt, even Apple with billions of dollars. What is important to understand, what you need to critically understand, is the ratio of short-term debt to cash and how it moves over time, okay? Is it moving up, down, left, or right in proportion with cash, okay? We really need to figure out, is cash growing with the increase in short-term debt, okay? You can't overlook this, and I'm sorry to beat it with a dead horse, but it's critically important. Now remember, companies can have both short-term and long-term debt. Warren ideally only wants to see short-term debt, albeit in a smaller proportion to cash. When Warren sees long-term debt, he really starts asking some fundamental questions. If long-term debt is primarily used for business operating purposes, Warren gets very concerned. If the long-term debt is used for business expansion, Warren's going to do a few more analyses to see if that current level of long-term debt is sustainable in proportion to the company's net income, which we'll find on the income statement, okay? We'll go over that in a little bit more. Really, the big thing with long-term debt is before Warren invests in the company, it wants to make sure it can service that debt in full in a reasonable period of time in case the worst happens, all right? Let's look at Apple's long-term debt, all right? Over the last 4 years, 2020 to 2017, Apple's long-term debt has held steady at about $100 billion. So if cash went from $20 billion in 2017 to $48 billion in 2019, and long-term debt hasn't increased during that period either, we can clearly say that Apple has generated its cash purely from its operations, or it raised stock, okay? It could do that. It could actually got it from operations, or it could raise stock. You can't see it right here in the balance sheet, and we'll see it in the cash flow statement. However, I can tell you that during that period, Apple has not raised any stock, okay? In fact, it's been buying back its stock in droves, all right? So this is why Apple is so valuable. Its cash increased, it nearly doubled over that amount of time, but its debt hasn't increased and it hasn't issued stock, okay? Purely from operations, it's really generating its cash. This is why Warren is smitten with Apple. It's a cash-generating behemoth. Now, you may be wondering, if Apple has so much cash and could really self-finance, why on earth does it have $100 billion of debt on its books? What did Warren's research reveal about that? Because you know he looked into it. Well, the reason is that a large majority of Apple's cash actually sits overseas, all right? Now, if it were to repatriate that money to the US, it would pay billions in taxes on it, and it really doesn't want to do that. However, shareholders want dividends, and they also want Apple stock price appreciation so they can sell their stock for a profit. So Apple needed to figure out something, all right? Now, what it figured out was quite clever, okay? Apple, instead of repatriating all its money to the US and spending billions on doing so through taxes, it decided to take out long-term loans and use that money to issue dividends and start buying back its stock, thus increasing the price, okay? So it basically found a very clever workaround to avoid paying all those taxes. Apple literally took on long-term debt in order to distribute profits to its investors, okay? And given that the company has such great cash flow from operations, it can easily service that debt and the interest payments, okay? So it's not a bad thing, okay, to see that long-term debt on there, all right? But Warren investigated it, of course, and it's totally fine, and it totally makes sense, okay? If you saw my video on the income statement of Apple, you would have realized that the interest income of Apple actually eclipses its interest expense. So essentially, on a net basis, it costs Apple nothing to take on this long-term debt and use it to distribute profits to its investors. So in summary, what's the lesson to be learned here when high-level analyzing a balance sheet? Warren and us as investors generally want to see increasing cash and decreasing debt, both short-term and long-term. Generally, we really don't want to see long-term debt, but if we do, we're going to start asking questions, okay? We really want to make sure that the company didn't take on long-term debt just because it knows that it can't fund its day-to-day operations and that the short-term loans aren't going to be enough, okay? So it's critical. If you see long-term debt, start asking questions. What is it being used for? What is management's plan with it? Okay, let's go back to the balance sheet and look at current marketable securities in the current assets section, all right? Current marketable securities are treasuries, bonds, and some other short-term cash products, all right? And these current marketable securities are basically as good as cash. They're super liquid, so you can really count it in the cash balance if you want to. I didn't here for our purposes because I want you to see strictly cash, all right? Best to be conservative. Apple actually uses its cash to purchase current marketable securities because it can squeeze out a small return on them. And that makes sense. Remember, you don't want to hold all your cash, billions of dollars, in a bank account because it's not earning you any interest. If you have the excess cash but aren't earning anything on it, you're typically going to buy current marketable securities to at least get you something so that it's just not sitting around, okay? That's not good financial management practice. That's why they buy a lot of current marketable securities. Warren also appreciates the fact that the current marketable securities amount is actually greater than cash, okay? That's wonderful, as he would say. Okay, we talked about cash, now let's talk about inventory. Ideally, you want to see a steady increase in inventory coupled with a steady increase in cash and net income, which you can find in the income statement. This indicates there is actual demand for your product. Rising net income should equate to rising inventory. This also indicates that you have some type of sustainable product that is not impacted by the economic cyclicality of the market, okay? Whether that's Christmas or a certain holiday, okay? Your product is needed year round. In Apple's case, as you would expect, it has increasing inventory with increasing cash and increasing net income, okay? The trifecta, everything Warren wants to see. All right, now on the flip side, what Warren does not like to see are sharp increases and decreases in the inventory levels over time. Inconsistent inventory levels indicate that the company has gone through boom and bust cycles, is in a highly competitive industry, and is really subject to the economic whims of the market. If you see sharp increases and decreases in inventory, you can also be guaranteed to see the same thing for the cash and net income levels, all right? They really do play hand in hand to each other. What Warren is looking for and what we're looking for is consistency, okay? Consistency equals investability. Moving down the balance sheet, the next account is accounts receivable, all right? Now, what is Warren looking for? Because this account can get pretty large. What Warren does is take the ratio of accounts receivable to the gross sales line item or the revenue line item from the income statement. Companies that have some type of competitive advantage will typically have a lower percentage of AR to gross sales, all right? And that competitive advantage is usually based on the quality of the product or service they are providing. Okay, again, what Warren is looking for is a low AR to gross sales margin. On the reverse, things to look out for and things to be concerned about is a high AR to gross sales margin. This high ratio indicates that the company is extending generous payment terms to its customers, usually in the realm of 90 to 120 days. Most competitive and well-run companies with an excellent product or service typically are only extending 30-day payment terms, not 90 to 120. If you're a company that is extending 90 to 120-day payment terms to your customers, that means you likely have an inferior product and are trying to compete on cost, which never works out in the long run. By competing on cost, you're essentially trying to undercut your competitors and really just steal them away, okay? That really indicates that you don't have a competitively sustainable advantage with your product or service, and it's not the best quality, okay? This is why the AR to gross sales revenue margin is just so telling to a company. Warren really focuses in on this number. Interesting side note, if your AR to gross sales ratio is high over a long term, it can indicate some type of accounting manipulation or impropriety deep within the business. Warren has found this to be the case a lot of the times when comparing the instances of fraud versus high AR to sales percentage, okay? So just something to keep an eye out when you're analyzing these companies. Now, Apple's AR to gross sales margin I calculated here, it's on average about 8%, which is super low. It's actually a wonderful number. Apple does not need to extend generous payment terms, okay? It has a superior product that people really demand. I'm actually gonna stop here right now because I gave you a lot to digest, and you really should watch this video a few times to really understand it, and do it while reading your own company's financial statements. It'll really start to make sense and really be helpful. And again, in recap, if you learned nothing this entire video, the most important trend to look for is cash to debt, okay? Cash should be going up, debt should be going down. That is general across the board. That indicates a self-financing and wonderful company to invest in, as Warren would say. Thanks for watching. I'll see you in part 2.